All right, we're looking at the equity section of a balance sheet. If you've ever looked at the equity section of a balance sheet, you'll see that shares have these three concepts of authorized, issued, and outstanding. And sometimes all three of them are identical. A lot of times they're going to be different. And I want to go through in this video why those three categories are related to the same shares of stock, but all three categories are very different. So let's dive into the difference between shares authorized, shares issued, and shares outstanding. Let's go. All right, shares authorized refers to the maximum number of shares that a corporation is legally permitted to issue. You're going to look to the articles of incorporation, and that is going to define how many shares a company can authorize. In our example here, Nakatomi Plaza Incorporated can issue up to 1 million shares of stock. That's what's stated in their articles of incorporation. Also stated with the articles of incorporation is the par value of that stock. In this instance here, the par value of one share of Nakatomi Plaza Incorporated is $100. That is the lowest amount it can be issued or redeemed for. In this scenario, if I were to issue all of my shares, all of Nakatomi Plaza shares at $100, everything went out at par, which is never the case. Very rarely are you issuing at par. I would raise $100 million. Now, with authorized shares, does that mean you are just absolutely limited? You're locked into 1 million shares? No. You are related to the articles of incorporation, but you can amend the articles of incorporation. Now, you got to go through the shareholder approval, the appropriate corporate governance to get the articles of incorporation amended. But you could always amend the articles of incorporation if you just decide later that you want to authorize 2 million shares or 100 million shares. You're limited to the articles of incorporation until you're not limited to the articles of incorporation. You just got to go through the legal process of amending them. And with the authorized shares, that doesn't mean they've been issued. This is just the bucket of shares available to issue. Before we go to shares issued, there's some considerations when you're setting up your C corporation on how many shares you do want to authorize. These are contemplations on what type of business you're running and how you want to run that. One area you want to think about is how much are you going to raise? How many shares do you need to issue to raise the amount of money that you need to fund your operations? So if you're doing some fundraising to raise equity, that's a consideration. Also, for employees, are you going to be issuing shares of stock in the future to them? Is there going to be a stock option plan? Employee compensation is a factor if that's part of your corporation's culture that you're going to be issuing shares or stock options. Mergers and acquisitions. Later down the road, you're going to be buying businesses. You're going to be merging with other businesses. You might be using equity shares of stock to offer to buy a business along with maybe cash. It really depends how a deal is structured, but equity can be a powerful tool for acquisitions. And control. This is probably the most important one you want to look at when you're setting up your authorized shares and very much your issued shares. Are you going to be a corporation that has an even playing field where you don't have anyone that owns maybe 1 or 2%? Or is it a situation where you want to make sure that you're in control of this corporation? So you want to make sure you own 70 to 80%. You want to own, when you issue those shares from the authorized bucket, you want to ensure that you have a controlling interest in this corporation so you can control its destiny. You have the power. These are the things you need to think about when you're setting up your articles of incorporation. That's a little too much when we're talking about shares authorized, but I just wanted to throw in that information. So let's go into shares issued. Shares issued comes out of the bucket of shares authorized. You cannot issue more shares than what has been authorized. In this example here, we have 1 million shares that have been authorized from the articles of incorporation, and we've issued half of them. We've issued $500,000. We've had 2 stock offerings, one in 2021, another in 2022, and we've raised cash to fund our operations. And when you're issuing common stock, in this instance in 2021, we issued 300,000 shares at a stock price of $150. Now that raised $45 million. When you're getting into the journal entries of the accounting, you're going to recognize the par value that we talked about with the shares authorized. In this instance, it was $100. You're going to apply $100 of the $150 share price to par value, which is $30 million. And anything above the par value is going to get bucketed into additional paid-in capital. So if you've ever looked at the equity section of a balance sheet, you'll see par value. That is the price of the stock, the lowest price it can be bought and sold for. And then anything over and above that's been paid for that stock is funneled into additional paid-in capital. So my first issuance, we have a breakdown of the $45 million we raised between $30 million of par value stock and $15 million that was put into additional paid-in capital for the total of $45 million of cash raised for issuing 300,000 shares. And then we did this again in 2022. We issued 200,000 shares. The stock price went up $225 a share. Total value still $45 million, but the stock price went up. We actually issued less shares. So the par value for the 200,000 shares was $20 million, but the additional paid-in capital is now $25 million. That is how par value and additional paid-in capital gets broken down. Now, with shares issued, that means somebody has actually owned it at some point. It doesn't mean it's outstanding. Someone might not own it at this point, and we're going to go through that in outstanding, why there's a difference between issued and why there's a difference between outstanding. I'm going to stick on shares issued for a second. Every time you issue more shares, you're diluting the stockholders. Those initial stockholders that received those 300,000 shares were subsequently diluted unless they got the exact prorated amount to keep their percent of ownership of the C corporation intact. They're going to get diluted if they're issued to different shareholders. Dilution is when a company issues new shares, the existing shareholder ownership percentage is diluted. For example, if you own 10% of a company and it issues more shares, your ownership percentage will decrease unless, as I said before, you buy additional shares. Other considerations when you start getting diluted is the voting power. If you do not retain the same percentage of shares, depending what the corporate governance says, what the articles of incorporation say, if you get below a certain threshold, maybe the number of shares you own doesn't give you the voting power that you had before the share issuance. So that's just a consideration. Let's transition to shares outstanding, because if you can see in our example here, issued and outstanding is different. Why is there a difference between issued and outstanding? If I've issued the stock, why isn't it outstanding? Well, there's this concept of treasury stock and stock buybacks. A lot of times, C corporations or corporations, if they have excess cash, they might consider buying back shares of stock. That means the stock has been issued, and if the corporation buys it back, it's not outstanding anymore. So that's why you have a different amount in this scenario and other balance sheets where issued and outstanding can be different. Here in 2023, Nakatomi Plaza bought back 50,000 shares at $250. So they had to use $12,500 of cash to redeem these shares, but they took them out of circulations. They've been issued, but they're not currently outstanding. No one owns those shares. The company has put them back in their bucket. They can be reissued in the future, but right now they're not outstanding. So outstanding really determines who owns the company. 400,000 shares is really what's outstanding. Those 400,000 shares are what determines who owns this company. We also have another treasury stock example here in 2024. We redeemed another 50,000 shares at $300. Share price went up, and that the company used $15 million of cash to buy back those shares to get us fully at that $400,000 of shares outstanding. Outstanding means who currently owns the shares, who currently owns the company. Now, if we put the whole thing together in this scenario that we have, Nakatomi Plaza Incorporated, per their articles of incorporation, has authorized 1 million shares. They then issued 500,000 shares to raise cash for the business. They are able to raise $90 million to start this business. A couple years down the road, they decided, hey, we have some excess cash. We want to buy back some of those shares. So in this instance, they bought back 100,000 shares, which leaves 400,000 shares currently outstanding as of 12/31/2024. So earnings per share is going to get calculated off outstanding shares, voting rights, ownership, dividends are going to be based upon shares outstanding, not issued shares and not authorized shares. So that's one consideration with outstanding. Those are the ones that are going to receive dividends. Those are the shareholders that are going to be voting, and those are the shareholders that ultimately currently own the company. I hope this was helpful defining the different buckets of authorized, issued, and outstanding, and it gives you a little bit more clarity. When you look at the balance sheet, you can see what the difference is between those three buckets. I hope you learned something from watching this video. Have a good rest of the day. Take care, and I will see you in the next one.